Good morning. This is XPulse AI Morning Mix. It's Monday, July 6th, 2026. Today, OpenAI's IPO talk hits $1 trillion note, Nvidia's next rack system reportedly slips to 2028, and Microsoft goes all in on enterprise deployments. Orion's here. Ready to jump in?
Ready, let's do it.
Yahoo Finance, citing the New York Times, reported on July 4th that OpenAI is leaning toward a 2027 IPO, and Sam Altman is reportedly unwilling to go public below a $1 trillion valuation. Orion, what's actually being signaled here?
Two signals, timing and price. Timing shifts later, more time to grow revenue and reduce surprises. Price sets a psychological floor. We're not a normal software company. The report also says OpenAI discussed offering about 5% equity to the U.S. government tied to public interest commitments and oversight.
5% to the government? Does that read like regulation by cap table?
A bit, yes. It's a way to formalize governance without rewriting the whole system. It could also reassure policymakers about safety and access while giving OpenAI cover to keep scaling. But it's unusual. Most companies don't add shareholder, federal government to the org chart.
And Microsoft's stake? Does it become the easiest way to own the outcome?
That's the implication in the coverage. If public investors want exposure before an IPO, Microsoft is the liquid proxy. Also, any IPO structure has to harmonize with Microsoft's existing rights, so even rumor-level IPO talk tends to move Microsoft into the conversation.
CNBC reported today, July 6th, citing SemiAnalysis, that Nvidia's next-gen Kyber rack-scale system, meant to host Rubin Ultra chips, has been pushed into 2028 amid manufacturing problems. Orion, how big of a deal is a rack delay versus a chip delay?
For large buyers, racks are the product. The rack defines power delivery, networking, cooling, serviceability, everything that turns chips into usable compute. If Kyber slips a year plus, customers building data centers may have to choose, deploy an older Nvidia platform, or consider alternatives like AMD or Google's in-house stacks.
So the risk is less, Nvidia loses more, the market fragments.
Exactly. Nvidia's cadence has been part engineering, part expectation setting. A rack-scale slip creates a window where competitors can win full platform deals, chips plus systems plus software integration. Once a customer standardizes on a platform, switching back isn't quick, like changing planes mid-flight, but with more cables.
What should we watch for over the next quarter?
Look for hyperscalers signaling mixed fleets, Nvidia plus something else, and for system integrators promoting non-Nvidia reference designs. Also watch whether Nvidia leans harder on partnerships to bridge the gap, like pre-built good enough racks while Kyber gets sorted.
Economic Times CIO wrote on July 4th that Microsoft is launching a new business unit of roughly 6,000 people focused on helping customers implement AI across operations. Orion, is this basically consulting or something else?
It's consulting plus product feedback in one loop. Microsoft saying, pilots are easy, production is hard, data plumbing, security, change management, training. So they're staffing engineers, trainers, and industry specialists to sit with customers and turn prototypes into real workflows, then feed those lessons back into Azure and Copilot roadmaps.
What does that do to the partner ecosystem, Accenture, the big SI firms?
It raises the bar. Partners won't disappear, but Microsoft is moving closer to the customer's last mile, where value and budget live. The smart partners will align, co-deliver on bigger transformations because Microsoft can bring product leverage and partners bring deep process expertise and long-term operating support.
Any tell on where enterprise AI is stuck right now?
The stuck point is repeatability. One chatbot demo is fine. 50 business processes with audit trails, access controls, and measurable outcomes is different. This unit is Microsoft acknowledging that scale needs people, not just models.
The Guardian reported on July 4th that NHS England will add AI-driven triage to the NHS app, aiming to direct patients to appropriate services, with an update expected to reach about 200,000 patients over the next year as part of a wider £10 billion modernization package. Orion, what's the upside?
If it works, it reduces friction at the front door. Fewer unnecessary urgent care visits, better routing to pharmacy, primary care, or self-care guidance. It can also standardize intake questions and capture better structured data, which helps downstream scheduling and clinical prioritization.
And the risk, mis-triage?
Mis-triage, plus governance. The reporting notes calls for clearer standards, protections for clinical oversight, and funding safeguards. In healthcare, the model isn't the whole system. The escalation rules, audit logs, and clinician review paths matter as much as accuracy.
So AI in the app is really AI plus process.
Yes, the safest versions behave like a well-designed intake nurse: structured questions, conservative escalation, and clear handoff. The danger is treating it like a generic assistant and hoping it magically understands policy, liability, and clinical nuance.
Business Insider summarized two reports on July 6th analyzing nearly 22,000 U.S. firms, finding AI adoption alone doesn't reliably produce financial returns. Companies need complementary investments and organizational change. Orion, what did the data actually say in plain terms?
Buying AI is not the same as using AI. Firms that sustained high-intensity use and integrated it into processes, training people, redesigning workflows, measuring outcomes, saw better results. Everyone else got scattered experimentation, a lot of logins, not a lot of changed work.
What's one pattern that separates "we tried AI" from "AI moved the needle"?
Owning the workflow. The winners don't just give staff a chat tool. They decide where decisions happen, what gets automated, what gets reviewed, and what metrics improve. It's boring on purpose: documentation, governance, and habits. Glamour is optional. Operational discipline isn't.
So the subscription isn't the transformation.
Right? If AI is a gym membership, these reports say showing up matters more than paying.
All right, a few quick hits to round out the morning: consumer AI pricing, internal tool spend, huge infrastructure bets, and some geopolitics and IT market moves.
On July 4th, Futurism reported Meta is putting key AI glasses features behind a $19.99 per month Meta One premium tier. More access, fewer limits, but now your glasses come with a subscription. Also July 4th, Tech Times reports Tesla is capping employee spend on third-party AI tools at $200 per week, with xAI's Grok exempt.
Nothing says standardized tooling like a weekly allowance.
Exactly, and it signals cost control and data control. Meanwhile, Memeburn, citing Bloomberg reporting on July 5th, says Meta may spend up to $145 billion on AI infrastructure in 2026 and is exploring selling compute to other companies, turning a cost center into a product.
And on the global stage, who gets access to frontier models?
Times of India reported July 6th that NATO summit discussions in Ankara include European pressure on the U.S. over access and control of frontier AI, with OpenAI and Anthropic referenced in that debate. Separately, Live Mint on July 5th says top Indian IT firms spent about $4.5 billion on acquisitions in the first half of 2026 to build AI capabilities. And the Financial Express notes domestic funds rotating into picks and shovels, Indian IT names seen as AI beneficiaries.
That's Xpulse AI Morning Mix from Xpulse for Monday, July 6, 2026. If this helped, share it with a teammate who lives in meetings and runs on headlines. See you next time.